Good morning. Let's make a brief study on HOKU. But let me start by saying that this is really a brief study. I looked at this talk for about half an hour, so probably I'm gonna miss several things. But let's do it. Okay, we have the chart here since the IPO. You can see the IPO was roughly at the same price the stock is now here in August 2005, and let's check this more short-term chart. Well, here we had this huge gap on the Sanyu news, and then the stock drifted lower until it touched here the 200 days moving average. It almost closed the gap completely, and yesterday we had another huge news saying that SunPower signed an agreement with the HOKU to more than $600 million agreement, but over 10 years. So technically, well, the stock closed below this very important resistance level of $7.54, and this is a bearish candlestick. This was a huge resistance level, but I believe the stock came off because of this part of the news. Where is the news? Just a second. Okay, of this part of the news where it says HOKU estimates that the establishment of this plant may require total construction costs of approximately $260 million. In connection with the financing of this construction, HOKU intends to seek debt capital of approximately $150 million. And what about the remaining $110 million? I know that they have about $30 million in cash, but I wonder if there won't be a private placement here, because there still needs some more money to make the plant, even with this $150 million debt capital. So I see a private placement coming here. And so let's move on to my valuation model. Let me try to explain this very quickly. Well, we have these yellow lines, which are known facts. These white lines are my estimates. There are only 4, and these dark yellow lines are calculated by this Excel spreadsheet. So we have the initial share price $6.75, the current share count, which is 16.5 million shares, and over the past few quarters, let me try to put this here. Okay, well, just a second, please. Okay, over the past 4 quarters, if we check here the diluted weighted average shares, it has remained more or less the same. So there wasn't any dilution over the past 5 quarters, but I think it's inevitable going forward. So I put here a 1.2 dilution factor. This means 20% share count increase over the next 3 years. This may be done in one big private placement, and I expect the share count to rise to 28.5 million shares. Initial revenue, this is the revenue the company had over the past 4 quarters. It was just 5.6 million, but I expect this to grow 178% a year to 120 million. Well, not a year, but I expect final revenue. This is the revenue of the year between mid 2009 and mid 2010 of 120 million. Well, this is considering the Sanyu agreement is a 7-year agreement. I've divided the total value of the contract by 7, and this SunPower agreement I divided by 10 and got to 120 million a year rate. But well, I'm a bit afraid that the contract isn't divided in equal amounts over the 10-year period. It may be less in the beginning and more in the latter part of the agreement. But let's consider this 120 million revenue rate per year. Well, initial net profit margin over the past 4 quarters, it was minus 2.33%. And I estimate the long-term net profit margin of this business to be about 10%, because solar solar companies have more or less this net profit margin. Even Chinese companies that make those solar panels, the cheapest in the world, they have 10% net profit margin, and it has been shrinking. So this company will make what is essentially a commodity, polysilicon, and so I expect about 10% net profit margin, and this gives me final net income estimate of $12 million, and this with 28.5 million shares outstanding gives me 42 cents earnings per share estimate. If we apply to this 22 earnings multiple, which is the, let me try to put here, where is this? Yahoo. Okay. Well, HOKU is in the, just a second, is in the diversified electronics industry, which trades at an average of 22 times earnings. So I put here 22, and this gives me a final estimated share price, this for mid 2007, of $9.23. This means I expect a share price compound annual growth rate of 11% per year, and that's not attractive for me because I'm looking for at least 16%, which is double the market average of 8%. That has been the average over the past 200 years. It was 8%, and I expect HOKU to rise 11% a year given these estimates. So not enough. If the stock were to fall down to 5.92 or lower, it would start being attractive again considering this. So I'm going to consider the stock will go down some to close this gap and perhaps touch the 50 days moving average about 5.5 or so. Then I would consider it again, or if there are more fundamental developments. But with the recent fundamental landscape, I believe the stock is worth less than $6. So, but I still expected it to rise a bit more than the general market. So on a 1 to 10 scale, I give it a 6. Thanks. Bye.